Welcome to the FinTickAI Weekly Market Analysis, providing a strategic outlook for Indian equities next week. This week, we navigated a macro-structural context defined by extreme dichotomies, profound realignment and volatility balanced against contradictory forces like robust domestic indicators and geopolitical escalations. Following a devastating Thursday capitulation, where the Sensex plummeted 1,236.11 points and the Nifty 50 surrendered 365 points, the markets engineered a resilient, yet highly selective recovery during the final trading session. Market drivers included external forces like escalating geopolitical friction between the US and Iran, catalyzing a sharp spike in global energy markets. Brent crude surged past $71.92 per barrel, threatening India's fiscal deficit. Countering this external negativity is India's domestic economic strength. The HSBC India Composite PMI hit a 15-month peak, driven by exceptional factory output and robust services sector demand, confirming structural insulation. The market architecture shows sectoral rotation, with institutional capital moving out of high-beta mid and IT equities. Funds are seeking safety in large-cap manufacturing, heavy engineering, and financial institutions. Analyzing the Nifty 50 technical anatomy, the index concluded the volatile week at 25,571.25, with a Friday gain of 116.90 points, reclaiming the critical 25,550.6 support barrier. Despite the recovery, significant underlying structural damage remains from Thursday's sell-off. The index formed a massive bearish engulfing pattern, slicing through the 25,500 to 26,000 support zone. The velocity of the decline forced the index below vital short-term moving averages. The 200-day EMA, near 25,200, is now the ultimate defense. Failure here could trigger accelerated capitulation towards the 24,800 to 24,500 zones. Momentum oscillators and technical indicators corroborate a highly cautious, neutral to bearish stance. The 14-day RSI hovers below the 50 midline, and MACD remains entrenched in negative territory, signaling a structural sell. Reviewing the Nifty 50 technical indicators matrix, RSI is neutral, MACD indicates a sell signal, and stochastic is overbought. ADX signals a fragmented trend, while Williams %R suggests exhaustion. Derivative market positioning defines the operational boundaries. Maximum call open interest is concentrated at 26,000. The immediate operational range is projected between 25,200 and 25,600. In stark contrast, the Bank Nifty Index demonstrated remarkable relative resilience, acting as the primary stabilizing force. It achieved a notable Friday gain of over 432 points, recovering from a massive bearish engulfing pattern. The foundational integrity of the banking sector remains uncompromised. The index found aggressive buying interest at its 21-day EMA, confirming that the primary bull trend in financials remains intact. Technical indicators for Bank Nifty are more constructive. The 14-day RSI is at 52.31, and MACD registers a strong positive value, generating a definitive buy signal. Upward momentum is systematically stabilizing. The Bank Nifty technical matrix identifies key levels: resistance 1 at 61,350 and resistance 2 at 61,750. The central pivot point is 60,343, with structural support at 60,300 and macro support at 60,000. Derivative options data for Bank Nifty shows the highest put writing at the 61,100 strike, suggesting a resilient support base. The near-term outlook is likely oscillation within the 60,000 to 61,500 range. Indian equity market microstructure is dictated by sharply divergent institutional flows and elevated hedging demand. A structural outflow of foreign portfolio investment continues towards the USA, driven by higher-yielding debt and AI infrastructure investment. Conversely, domestic institutional investors, DIIs, act as the critical counter-cyclical anchor. Consistent inflows from domestic mutual fund SIPs provide a steady liquidity floor, absorbing foreign supply and preventing a systemic breakdown. Volatility, quantified by the India VIX, surged over 10.15% to 13.46. This spike denotes elevated demand for portfolio hedging, correlated with Middle Eastern geopolitical stability, global inflation uncertainties, and deep-seated apprehension regarding IT sector valuations. Turning our attention to the news cycle, market sentiment is currently deeply bifurcated. Globally, markets are on high alert following President Trump's stark 10 to 15-day military warning to Iran, which has driven massive safe haven accumulation in gold and bonds. Domestically, however, the story is entirely different. India received a powerful fundamental injection, with the HSBC Composite PMI printing at an exceptional 59.3. Adding to this bullish domestic tone, India's strategic entry into the PACEDIGITK semiconductor supply chain framework fueled a strong Friday recovery, particularly in manufacturing and industrial equities. Let's look at who captured that momentum. Here are the top weekly gainers on the Nifty 500. Godfrey Phillips led the pack with a staggering 19.5% gain on high volume. We also saw massive moves in the IT hardware space, with NetWeb Technologies surging 17.4%. Nugent Software, Transformers and Rectifiers, and Schneider Electric rounded out the top 5, all posting double-digit gains well over 13%. On the flip side, the market was unforgiving to equities facing structural headwinds. Quality Walls was decimated, dropping 31% to hit a 52-week low. Brainbee Solutions shed 18.7% and breached its 200-day moving average. Ola Electric also took a heavy beating, down 14.1%, alongside double-digit drops for TBO Tech and Blue Jet Healthcare. Price action tells you what is happening, but volume tells you why. Let's dissect this week's high-conviction volume outliers. These, quote, volume shockers experienced dramatic shifts in trading volume relative to their historical averages, giving us an unfiltered look into hidden institutional accumulation. This week produced several highly actionable anomalies. First up is NetWeb Technologies. The stock dominated scanners, surging intraday with trading volume exploding to over 89 lakh shares, a massive deviation from its mean. The catalyst? An aggressive institutional buying frenzy, triggered by their pivot into the sovereign AI infrastructure space. NetWeb announced the Tyrone Camarero Spark, touted as the world's smallest AI supercomputer, powered by the NVIDIA GB10 Grace Blackwell superchip. This positions them perfectly for the global AI hardware boom. Next is PACEDIGITK. We saw intense trading volume after the company secured a massive 199.4 crore rupees letter of award from Larsen & Toubro Construction. This contract is for utility-grade battery energy storage systems for the Bihar State Power Generation Company. This single order dramatically alters PACEDIGITK's revenue trajectory, elevating them to a Tier 1 player in the lucrative grid stabilization sector. Finally, Godfrey Phillips experienced a multi-day momentum rocket, accumulating over 31% across just 3 trading sessions on sustained volume exceeding 1.12 crore shares. While indicators like the RSI are flashing extreme overbought conditions above 62, the raw price action confirms aggressive, unhedged momentum buying by institutions. Moving to structural market health, analyzing 52-week extremes helps us separate blue sky momentum from terminal decay. The BSE 200 index saw several heavyweights smash through to 52-week peaks this week, emphatically confirming the prevailing strength in capital goods, infrastructure, and energy supercycles. Specifically, Hitachi Energy touched a breathtaking all-time high of 23,999 rupees and 30 paise, appreciating by a staggering 43% in a single month on grid modernization demand. Larsen & Toubro peaked at 4,390 rupees on record-breaking order books. Furthermore, public sector titans ONGC and NTPC climbed to new highs, driven by favorable crude realizations and monopolistic cash generation. Conversely, companies facing intense margin compression sank to their annual depths. Vedant Fashions collapsed to a lifetime low near 425 rupees and 80 paise due to flat results and an expensive price-to-book ratio. We also saw L&T Technology Services and First Source Solutions hit painful 52-week lows as forward revenue forecasts were aggressively trimmed. Finally, Ola Electric dropped precipitously following a severe downgrade to sell by Citigroup, citing sluggish EV penetration and ongoing market share erosion. Zooming out, the global macroeconomic landscape is rapidly fracturing into distinct geographic realities. Global equities are navigating a treacherous environment defined by shifting monetary policies, unprecedented legal rulings on trade, and the unyielding momentum of AI. In the United States, the economy is a paradox of tech hypergrowth versus severe trade policy uncertainty. Equity markets faced downward pressure as institutions rotated out of financials due to geopolitical strife and sticky inflation metrics. The recent FOMC minutes confirmed deep divisions, signaling that rate cuts will be highly data-dependent and likely delayed. However, the defining global policy shock emanated from the U.S. Supreme Court. In a landmark 6-3 decision, the court ruled that the president exceeded executive authority by imposing vast global tariffs under the IEEPA. While this temporarily alleviates immense pricing pressure on global supply chains, it simultaneously nullifies recent interim trade agreements the U.S. negotiated with allies like India, rendering those pacts potentially obsolete. This ruling creates extreme trade uncertainty globally, but for Indian exporters, particularly in textiles, apparel, and auto parts, it is a massive relief. Companies with high U.S. revenue exposure are now positioned to reclaim competitive advantages as bureaucratic hurdles are reduced. Beyond trade, Wall Street remains hyper-focused on the digital brain of the tech sector, NVIDIA. As the undeniable bellwether, its cloud computing advancements continue to create massive spillover effects that heavily influence Indian tech and manufacturing outlooks. Over in Europe, equities exhibited surprising localized resilience. In the United Kingdom, the FTSE 100 traded significantly higher, standing up to the broader global market divestment trends. This UK resilience was backed by a flash composite PMI that surged to a highly impressive 22-month high of 53.9, with the manufacturing sub-index hitting an 18-month high. However, looking under the surface reveals a darker reality. This growth is being driven by a severe corporate focus on aggressive cost-cutting, resulting in steep consecutive months of job losses as efficiency is prioritized over workforce expansion. Germany offered a glimmer of recovery, with the DAX 40 seeing its PMI rise to 53.1. Crucially, the German manufacturing sector solidly re-entered expansionary territory. Yet, similar to the UK, corporate personnel planning remains heavily constrained and cautious. Finally, in the Asia-Pacific region, the Bank of Japan is walking a highly complex tightrope regarding the normalization of its monetary policy. Japan delivered a macroeconomic shock when headline inflation unexpectedly decelerated to 1.5%. Despite this apparent deflationary drift, structural analysis indicates this is due to temporary, localized factors. Consequently, global bond markets believe the BOJ is highly unlikely to delay its planned cycle of interest rate hikes. This impending contraction of cheap yen liquidity will have vast, systemic implications for global carry trades. Now let's turn these macro insights into actionable trades. Welcome to the FinTickAI Alpha Portfolio Core. We have isolated the top 4 asymmetric trade setups for the week commencing February 23, 2026. These setups rely on a rigorous confluence of quantitative moving averages, volume standard deviation anomalies, and deep fundamental catalysts. Based on our models, these have a 90% probability of hitting their targets, offering a clear, asymmetric risk-reward profile tailored to current volatility. Our first setup is PACEDIGITK. The current market price is 182 rupees and 16 paise. We have a target zone of 230 rupees and a strict stop loss at 169 rupees, giving us an excellent 1 to 3.63 risk-to-reward ratio. Technically, the stock is experiencing severe price compression within an IPO-based structure, signaling an explosive breakout. Fundamentally, this is triggered by that massive 199.4 crore rupees BESS order from L&T, fundamentally de-risking the company's valuation. Setup number 2 is Pricol. Current market price is 633 rupees. Target is 680 rupees with a stop loss at 610 rupees, yielding a 1 to 2.04 risk-reward ratio. Pricol maintains a highly reliable bullish structure on the daily chart, with higher highs and higher lows. It is trading confidently above both its 20-day and 50-day EMAs, indicating sustained short-term strength and dominant bullish momentum. Our third setup is SAIL. The current market price is 162 rupees. We are targeting 174 rupees with a stop loss at 156 rupees. A clean 1 to 2.00 risk to reward. Supported by strong sectoral momentum in the metals space and favorable macro indicators from China, SAIL is demonstrating notable relative strength against the broader index, signaling robust institutional accumulation at lower levels. Our final high conviction setup is Balkrishna Industries. Current price is 2,494 rupees and 80 paise. Target zone is 2,820 rupees with a very tight stop loss at 2,448 rupees and 73 paise. This offers a phenomenal 1 to 7.05 risk-reward ratio. This deep value trade currently rests on major structural support and is heavily reacting to the US Supreme Court's invalidation of global tariffs, which instantly restores their export competitiveness. Please note, this video is for informational purposes only. Investment in the securities market is subject to market risks. Past performance is not indicative of future results. Consult your financial advisor before making any investment decisions.